ETFs, mutual funds, and index funds are three of the most popular names or phrases that you hear when it comes to investment. But which one is best for your money? Which one fits your long-term or short-term financial goals and your risk tolerance level? So in this video, we will break them down side by side. By the end of the video, you'll know exactly which type of funds fits your investment strategy. Welcome to Ben Talks Money. My name is Ben. I have an MBA in finance and management, and I have been trading for the past 8 years. So let's get started. First of all, let's look at the basics. First, what is an ETF? An ETF, or exchange traded fund, is like a basket of investment. You can buy and sell on the stock exchange just like any other stock. So for example, an ETF can comprise of Amazon stock, Apple stock, Nvidia stock, or all your favorite stocks. When it comes to ETF, they are usually created based on the sector. You can get an ETF for the NASDAQ, the tech stocks. You can get an ETF for the housing sector. You can get an ETF for the healthcare sector. That's how ETFs are usually created. And some of the most popular ETFs are the QQQ, which tracks all the tech stocks, the SPY, which tracks the S&P 500 stocks, the DIA, which tracks the Dow Jones Industrial Averages. These are just a few. There are thousands and thousands of ETFs available. So what is a mutual fund? So a mutual fund is a pooled investment vehicle where a professional manager decides which stocks or bonds to buy. So a mutual fund can be actively managed, where a manager tries to beat the market. In financial terms, you call achieving alpha. Beta is the market standard. If let's say on average the stock market, the S&P goes up 15% or let's say 10% a year, if a mutual fund manager achieves that is the beta. So every investment manager, portfolio manager, tries to achieve alpha, which is beating the market. So that is what mutual funds are. They can also be passively managed like an index fund, but they treat differently and often come with a higher fees. And what is an index fund? So an index fund is a type of mutual fund that replicate the performance of the stock market, like the S&P 500. They are not traded throughout the day, but they are some of the cheapest and simplest and most reliable investment vehicles for long-term investors. So you can invest in the S&P 500 index. You can invest in the Dow Industrial Average Index. You can invest in the Russell Index, which tracks all the small caps, the small companies. So those are index funds. And then let's look at how all these funds came about. First is the mutual fund. So the mutual fund was first launched in 1924 in Massachusetts. And when it comes to the index fund, the first index fund was created by Vanguard in 1976 by an investor called John Bogle. So this is the legendary Vanguard 500 index fund that with the ticker symbol VFAX. That is the oldest index fund on the market right now. When was the first ETF created? The first ETF was created in 1993, and that is the SPY. If you heard about the SPY, the ticker symbol SPY, which tracks the S&P 500 index fund. It tracks that. That is the first ETF that was ever created. And today there are trillions of dollars invested in all these three funds: index funds, ETFs, and mutual funds. So let's look at their accessibility and their flexibility. With an ETF, you can buy any ETF that you want in any trading platform. Robinhood, Schwab's, whatever you use to trade, you can buy and sell ETFs there. They are highly accessible compared to the other two. And when it comes to index and mutual funds, on the other hand, they don't trade intraday. You buy and sell them once per day at the closing. And if you want flexibility, the best for flexibility is the ETF. ETFs gives you the best flexibility. You have control over it anytime you want. Now there are extended periods for a lot of trading exchanges. Even Robinhood has 24-hour trading services where you can trade throughout the day. every day, 24 hours, except for Saturdays and Sundays, right? So let's look at the costs involved in the cost and the fees involved in these funds. So with an ETF, the cost is generally low. You can, you can, because it's not actively managed. Most of the ETFs are not actively managed. The cost is very, very low. Some of them charges as low as 0.03%, for maintenance fee. So ETFs have a really, really low fee. And when it comes to index funds, they also have extremely low cost. The Vanguard 500 index fund charges just 0.04%. So it's practically the same as the ETFs. And when it comes to mutual funds, they can be more expensive. The reason being that most or almost all mutual funds are actively managed. You have somebody who is just looking over your money for you. So most of them, you pay an entry fee, and then you also pay annually or monthly or based on the terms of the fund. And some of them charge between 0.5% to 2% in expense ratio. For example, the American Fund Growth Fund of America with the ticker symbol AGTHX charges 0.66%. So if you look at it, it's much higher compared to the index funds and the ETFs. And the reason being that you don't have to do anything. All you need is to put your money in it and go to bed, right? So let's look at the how much money, the minimum requirement for each of these funds. With ETF, there is no minimum requirement. Right now, exchanges like Robinhood, you can buy fractions of it. You can buy as low as $1. So the minimum requirement for investing in an ETF is just $1. You can buy a whole share or you can buy a fraction of it. When it comes to index funds, they usually have minimums. Some of their requirements usually ranges between $1,000 to $3,000 minimum to be able to invest in an index fund. And when it comes to mutual funds, they also have minimums. Their minimums are usually higher than the index funds, usually around $5,000, $1,000 to $5,000 to start with. And let's look at the tax efficiency. ETFs are very, very tax efficient. Index funds are fairly efficient because you don't trade, often. Index funds come second when it comes to taxes, and the mutual funds, because they are managed, you might not even know until weeks later what was done for you. You might not know until the end of the quarter. Usually you get a quarterly report, so you might not even know until at the end of the quarter before you know what happened, right? So that is what, when it comes to taxes, that is those are the differences. What is the best for you when it comes to your money? So it depends on your investment strategy and also your risk tolerance level, and the kind of oversight that you want on your investment. Okay, because if you take mutual funds, for example, these are what is in your 401ks and other pensions and stuff. You don't have visibility on it. So you cannot know exactly what is being bought for you. You just choose, usually on the 401k, they'll tell you they will give you a questionnaire to fill. How old are you? This, that. Are you your risk tolerance? And then they will decide and they'll choose something for you. So you don't have visibility in it. So if you want visibility in your investment, then an ETF is the best option for you. Okay. Because you choose what you want to buy, you choose when to buy, you choose when to sell. And you pay little to no fees. And, when it comes to index funds, if you want a long-term investment, you can put your money in something like the S&P 500, or the NASDAQ, something like that, an index like that. And then you just let it ride, because you know that no matter how much it drops down, the stock market historically is always up. So if you want a long-term vehicle that you can just ride, index fund is for you. But if you want something that all you need is to put your money in, you don't have to worry about what you are buying. You don't have to worry about how it's going. You just want somebody to do it for you, right? You don't want to think about what is an ETF or what is the stock market doing. and you don't mind paying the fees, the expense ratio, if you don't mind paying those fees, then mutual funds are the best option for you. That's it for the video today. We learn about what is an ETF, what is an index fund, and what is a mutual fund, the risk involved in them, and which one of them is good for you. If you have any comment, leave in the comment section below. If you want to know more, I will do a video about the best ETFs that you can buy if you want to self-trade. So look out for that video coming up next after this. And until next time, don't forget to subscribe to the channel, like the video, share, and let's keep talking money.